the case book and swore to give it back and didn't. I want it back. So if you want to leave it off, maybe you put it in my mailbox. I haven't looked yet. Secondly, I did make a mistake about the paper, but maybe it's not a mistake, and I'll do this democratically. Remember when I said the optional papers were due on April 16th? That was when this was a whole term-long course. I still don't mind doing that as long as you don't mind getting your grades really late for the first half of the course. I mean, it's not a lot of suspense about what your grades are going to be, right? So I'm willing to give you the whole semester to basically do that paper. What it means is that we will announce the winners, not in this class, but in the second, at the end of the second class. So if you want to go to the last class of that and see who won, we'll announce it there. That is my preference for doing it, because I think that late in the semester, when you're getting ready to leave, is a good time to give you the money. Whereas in the middle of the semester, it'll just vanish in the anxiety of your job search. If, however, you want us to give the prize on the last day of this class and get the grades in soon thereafter, the paper would be due on February 25th. So how many people you have? Don't be intimidated by the mob. We're going to have a vote. How many people would like the papers to be due April 16th? How many people want it February 24th? The people have spoken. They'll be due March 16th, and I'll have the TAs email all the members of the class for who the winners are. All right. Remember, we're talking about successful processes for making market investments. The fact you can never forget about this process is it is a zero-sum game. Every investment has a buyer and a seller, and one of them, in some sense, is always going to be on the wrong side of that transaction. That means when you think about an investment process, you have to start with a search strategy that is a strategy for what investment opportunities you're going to investigate in detail that is more likely than not to put you on the right side of that trade. Tano showed you a mountain of statistical evidence for what the opportunities look like that tend to outperform the market. What in general they look like is they're obscure. You're the only one, small caps, spin-offs, boring industries with low analyst coverage in countries nobody wants to visit. You're the only one talking to a company. That is a good sign. The company has 200 analysts when it has an analyst day. That's obviously a much tougher environment to be on the right side of the trade on. Undesirable is your friend, and undesirable almost always means cheap. Low market to book, low price earnings, low growth, industries that have problems, companies that have problems, where there are large losses. Those are your friends. Sometimes, too, you have the government on the other side of the trade. That is great. When the government sells off assets without generating a lot of auction buyers, as they did when they shut down the S&Ls in the early 90s, you want to be at that auction, especially if there aren't a lot of other people. The privatizations in Eastern Europe, where government's giving away assets and you don't have a sophisticated buyer on the other side of the trade. So you have to decide what your strategy is going to be. Now, in addition to the statistical evidence, which is historical, although it's been around for a long time and nobody's learned, you do want to have a rationale rooted in human behavior that means these kinds of securities are likely to do well in the future. And there are deeply ingrained human tendencies that presumably account for the statistical regularities that Tano showed you in the past, and trust me, they haven't changed. First, people don't like the prospect of losses. In probably all aspects of life, ugly things are undervalued, not just in securities markets. People are loss averse. Secondly, lottery tickets have always sold. People will overpay for the prayer and the dream. And if you stay away from those stocks because other people are overinvested in those stocks, the corollary is that the cheap, ugly, boring stocks are going to tend to be undervalued to compensate for the overvaluation of the lottery ticket stocks. The last thing you have to remember is, and we'll come back to this when we talk about your own personal biases in investing, every investor thinks they know things with a much higher degree of certainty than is justified. They think it's going to do well. Nobody comes up to you and says, I have a great idea, and you say, well, is it going to be successful? And you say, well, maybe 60% of the time. But that's the reality. So when the consensus thinks stocks are good, they're going to overvalue them because they think stocks are good for sure. When the consensus thinks stocks are going to do badly, they're going to undervalue them because they think they're going to do badly for sure. And that's basically where you want to start. Now, there are other strategies. You'd be an industry expert. You'd be an expert in countries if they're obscure enough. But the basic strategies that seem to outperform in the long run are these cheap, ugly, obscure strategies. Now, on top of them, momentum also matters. People adjust slowly to new information. Stocks that go up tend to keep going up, and there are a lot of other explanations for that, institutional as well as individual. Institutions reinforce these biases. If you're a money manager, the evidence is that you keep the money as long as you don't stray too far from the herd, no matter how bad the performance of the herd is. Herding, therefore, is something that reinforces the attractive stocks being overvalued because everybody then buys them, and the unattractive, obscure, ugly stocks being undervalued. Institutional imperatives to look like good, gray, solid investors who go to church every Sunday at least 4 times means buying stocks that have done well, foregrounding those stocks in your portfolio, and therefore over-investing in those kinds of stocks. Now, there has been lately one other variation on the kinds of models that Tano told you about, and it's one that I introduced to you, and it's one that I recommend you use carefully. How many of you have heard of this book, The Little Book That Beats the Market by Joel Greenwald? Okay. It is a book that starts out with basically low PE stocks. But what it wants to do is find in those ugly collections of investment opportunities the best ones. So it looks for, you can think of this as the best of the worst, low PE, low market-to-book stocks that have high returns on invested capital. Or you can think of it as looking at the worst of the best, high return on invested capital companies in terms of their accounting returns that actually are selling for low PEs. Notice that that is a compromise of the basic strategy that we talked about. It is a strategy that does well, but its history of doing well is nothing like the 80-year plus history that Tano showed you on the value premium. In the case of the magic formula, it was done over 17 years. I would advise you to be careful about that, because what the evidence seems to indicate is that it's the extreme outliers that provide the value in these high-low strategies. It's the extremely low market-to-book, the bottom 2 deciles, that you want to invest in, the extremely high market to book, the glamour stocks that you want to stay away from, the top decile or the top 2 deciles. The best of the worst means you're not going to have the full force of irrational investor psychology on your side. It may still work, but I'd advise you to be careful about it. Another mechanical variation of this is work done by a guy called Petrosky. And what he did was he looked at the universe of stocks in the bottom decile of low market to book, low PE. The stocks that when you look at them, you go, yuck, I'm not touching that. And tried to identify the ones that he was willing to get his hands dirty on. And what he did was pose a sequence of yes-no questions about those stocks. So the first question he asked is there a positive or negative return on assets? And if there was a negative return on assets, there had been consistent losses over long periods of time. That's a bad answer to that question. Positive return on assets is a good answer. Is there positive, the second question he asked, is there positive cash flow from operations? Again, that's an accounting category on the cash flow statement. Positive is good, negative is bad. Is the return on assets going up or down? Going up is good, going down is bad. He didn't ask how much, he just asked yes or no. The difference between reported cash flow from operations over assets minus the reported profits on assets. You want excess cash flow is a good sign. If you're reporting higher profits than the cash flow, it's a bad sign. Is leverage increasing or decreasing? Increasing leverage is a bad sign. Is liquidity, which is your cash resources minus short-term debt, increasing or decreasing? Increasing liquidity is good. Has there been an equity offering lately? An equity offering lately is bad news. Why? Because I'm a manager and I look at the market price, and if it's $16 a share or $8 a share, if I thought my stock was worth $20 a share, would I issue equity at $8 a share? Not in a million years. If I think my stock is worth $6 a share, I'll issue equity all day long. Who knows more about that stock's value, me or you, the outside investor? I do. So issuing equity is a bad sign, and he asks if they've done equity issues recently. Are gross margins going up or down? Are asset turns deteriorating or improving? And then what he did was, based on the number of good answers, he divided the stocks within this lower decile of market to book into stocks he'd like to invest in and stocks he wouldn't. And he did it over a 20-year period. Typically, for a stock he wanted to invest in, he wanted 8 to 9 good answers. For a stock that he was going to stay away from in short, he wanted no more than 1 to 2 good answers. When he overlaid that on top of the basic value premium, he got an extra 8 to 10% in his 20-year sample period. Just like in the magic formula period, you basically get about the same amount more. Again, be really careful here, because these are strategies that people are going to look at those stocks and they're not going to say yuck. Maybe they will, but the evidence probably is that he's done a good job of identifying the best of the worst again is they're not going to say yuck. And you don't have the basic human irrationalities that we've talked about that have been identified in behavioral studies of investors and non-investors on his side. But you ought to be aware that at least in these sample periods, these modifications of the basic strategies that Tano told you about have performed reasonably well. Outside of the sample period, they haven't performed that well. I think that's... So far, this is a fairly old slide. The jury is still out on these changes. But you ought to be aware that that's a temptation that you're going to be exposed to. All right. What we're going to talk about next is when you found candidate opportunities to look at, and you're not just a quant, how are you going to go about finding out, is this a good investment without just applying a mechanical process? And that involves, if you're a value investor, putting a value on the company that you're buying. The reason we think that this makes sense for value investors in the Graham and Dodd tradition is they have an approach to valuation which you will see is very different from what you were taught in 6301 or even, I dare say, in advanced corporate finance. And by the end of tonight, you ought to recognize that it is much, much better than what you were taught to do. So what we're going to start with is talking about valuation approaches. And the most common, by far, it's not what you were necessarily taught to do in 6301, but it is what happens out there is people estimate some measure of cash flow, whether it's earnings after tax, EBIT, which is earnings before interest and taxes, which is what the operating business produces, EBIT plus amortization, because amortization is usually a phony charge. It's based on past stupidities, not prospective stupidities. Or EBIT plus depreciation and amortization, because in some businesses there really is not a lot of maintenance CapEx that's necessary to keep the business going. So they take a measure of cash flow and they apply a multiple to it. So they say, okay, this is $2 a share, and I think stocks in this industry should be trading at 15 times earnings. They get $30 a share for this stock, and they find a company that's trading at $26 a share, and they say, that's a great bargain. I'm going to buy that stock. But that's the fundamental valuation methodology that gets used. Now, the problem is, of course, where does this multiple come from? And what does it mean for the appropriate multiple for one company to be the same as the multiples at which, quote, comparable companies have traded either currently or in the recent past? When you look at comparable, there are a lot of different dimensions of potential comparable out there. There are differences in strength of economic position. Some companies will dominate their markets. Some companies will be in weaker economic positions. It's where you are in the cycle. Some companies have very severe cycles and their profits suffered a lot in the recent downturn. Other companies didn't suffer so much. How much leverage is there? Presumably more levered companies are riskier, like banks, and they ought to get lower multiples. So the cost of capital matters, and of course, the growth rate matters a lot. One company is growing not at all, and another company is growing at 6% a year, and you think that 6% growth is sustainable, the second company is going to be worth presumably a lot more. The problem is that for some of these things, you don't even know what the sign of the effect of these variables are. Management quality, is it a positive or negative? Should a company with a good management have a higher or a lower multiple? How many people think a higher multiple? Absolutely. Why?
Because there's value in the management. So
Yes, exactly. You got new projects coming up all the time. Good management doesn't piss away the resources that they retain out of earnings, and you get more money and more value creation out of that. What's the argument for bad management?
you double pay.
Yeah, good management is already in those earnings. And if the management is really good, what's the only direction it's got to go in the future? Down. What are you, an antichrist? if the red hat is suggested. And if it's going to be worse in the future, it means that current earnings are unusually high. So sometimes you don't even know the appropriate sign of the adjustment. But the big problem with this is the issue of quantification. In some sense, what a multiple valuation is it's a cash flow variable. And as you know from your terminal values in 6301, it's sort of cash flow times the difference between a growth rate and the cost of capital, where all these issues of risk are buried in the cost of capital, and all these issues of management, quality, and so on are buried in the growth rate. The problem is that if a typical growth rate, which is like nominal GDP, which in the old days used to be 5%, and a typical cost of capital is 10%, the multiple is 1 over 10% minus 5%, which is 1 over 5%, which is 20. But suppose you're 1% off in the growth rate. Is that hard to be? No. And you're 1% off in the cost of capital because you misestimate the leverage or something. If that's the case, then the cost of capital could be 11. The growth rate could be 4. It's 1 over 7%, 11 minus 4. 1 over 7% is 14 times, not 20 times. Or you could have overestimated the cost of capital and underestimated the growth rate, and suppose you're off by 1% there. Then the cost of capital is 9, 1 away from 10. The growth rate is 6, 1 away from 5. And you've got 1 over 9 minus 6, which is 1 over 3%, which is 33 times. The precision of these estimates ties down the value of your company within a factor of more than 2, from 14 to 33 for very small mistakes in that growth rate and cost of capital. Now, we know that this is the case, so what do we teach you to do? And this ought to be from, how many of you valued companies in 6301? You still do that exercise? Yeah, enough of you. This is, I hope, what they teach you to do, right? You estimate cash flows. How do you estimate cash flows? You estimate a market size and maybe a market share to get revenues. You estimate margins. That gives you pre-tax income. You do a tax rate on that minus maybe some overhead expense. That gives you net income. You subtract the investment requirements for any growth that's going on or the capital recovery. If it's shrinking, gives you an after-tax incremental cash flow. You estimate a cost of capital, and you do the cash flow for 5 years. Then what do? You do a terminal value, which is a terminal cash flow times 1 over the difference between the cost of capital and a growth rate, and you treat that last thing as an extra cash flow. The terminal value is a cash flow. You discount it back to the present, and you compare that value to the market value of the company. Does that sound right to people? Does that look familiar? Okay. Where was most of the value when you did this? It was all in the terminal value. So did it really help when you did that? Only that now you had to estimate the growth rate and the cost of capital, not today, but 5 years from today, or 7 years from today. Now, it turns out the problem with approximating the DCF, or discounted cash flow formula, which we teach you to do, is first the right thing to do in theory. If we knew what these cash flows were, if we knew what the cost of capital was, we would get the right answer for what this company is worth. Secondly, this is no worse, certainly, than what we just did with the ratio valuations. In fact, the ratio valuations is just doing the terminal value right up front. On the other hand, for 3 reasons that I'm going to describe to you, while this is right in theory, in practice, this is an incredibly stupid way to value a company. One of the reasons is absolutely clear and transparent. How many of you really seriously looked at the balance sheet information for your companies other than to do a stupid and irrelevant liquidation value? None of you. The balance sheet is very valuable information. If you're throwing away that information and somebody else has figured out a way to put it to good use, they're going to do a lot better than you in valuation, and they're much more likely to be on the right side of this trade. So throwing away the valuation information is not a smart thing to do. Second thing is up here at the top. Think about what you do when you do a net present value. You take the sum of near-term cash flows weighted by appropriate discount factors and distant cash flows in the future weighted by factors that, if you've got any kind of growth at all, are not that much lower. And you add them together to get the valuation. Where is there good information here? When you did those estimates, where was your good information? It was in your estimates of the near-term cash flows. What do you think is the quality of your estimate of the cash flows 10, 12, 15 years out that are buried in the terminal value? You think you have good estimates of those? No. So what you're doing is you're taking good information, which is your near-term cash flow estimates, and bad information, which is buried in the terminal value, and you're adding it together. And when you add bad information to good information, what do you wind up with? Bad information. The bad information, like the terminal value, dominates. And you would like to separate the implications of the good valuation information that you have from the implications of the bad valuation information. And a DCF valuation does not do that. Now, there is a sociological reason why that is true. A lot of you are going to go out and be investment bankers. And your job is to get company executives to do stupid things with their shareholders' money. To do that job well, a valuation technique that produces a lot of smoke and not much light is a really good valuation technique. And we know on which side of the bread Goldman Sachs applies the butter. And that's probably, in some sense, why we teach you to do this. There is, however, a third reason why this is a stupid way to proceed, and in a funny way, it's the most important. The way to think of a valuation rule in the most abstract sense is as kind of a meat grinder. You put in assumptions at the top, you turn the crank, and it generates a value or a range of valuations. The quality of the meat that comes out obviously depends on the quality of the assumptions, which is the meat that goes in. And what are the assumptions that you use when you do a DCF? Revenue and revenue growth for the next X years. Profit margins, we're starting perhaps with gross margins, and then after subtracting overhead, operating margins for the next several years. Tax rates to get after-tax income, a cost of capital, and capital intensities to get investment requirements associated with any growth that you have. Those are all parametric assumptions. How many of you know what Ford's operating margins are going to be 5 years from now? Anybody? Their growth rate? I don't think so. How many of you are able to make good assumptions about any of these things? And the answer is not really at all. Is it possible that at all? These are difficult assumptions to make. How do you compensate for that when you did your valuations? You do sensitivity analyses. But the sensitivity analyses vary one of these variables at a time. So you raise the return on sales without changing the capital intensity. But in practice, of course, they are related by economic imperatives. If capital intensity goes up and the industry is to stay viable, margins are going to have to go up. If capital intensity goes down and competition therefore intensifies, margins are going to go down. And they vary together in a complicated way. The problem, therefore, with a DCF approach is that it uses exactly the wrong assumptions. Now, there wouldn't be anything better that you could do if there were not things that we knew about the automobile industry 5 years from now. Is there going to be a viable automobile industry 5 years from now? Yes, there is. Is Ford going to have any technology that the other companies don't have, or is it not going to have technology that they have? Is technology widely available among the big auto companies? Yes, it is. Do they all have equal access to markets? Yes, they do. Do all the big ones have the scale necessary to compete globally? Yes, they do. Fundamentally, do any of those auto companies have competitive advantages over any other of those auto companies? No, they don't. What we would like is a valuation approach that enabled us to use those kinds of strategic assumptions, not the parametric assumptions that are embedded in a DCF calculation. You don't want to have to guess whether the profit rate is going to be 6%, the cost of capital in the future 10, investment per unit of sales 60%, whether the growth rate is 7 or not. What you'd like to be able to use is this industry economically viable or not? Is this a situation where nobody has any competitive advantage and there's free entry? If firms enjoy competitive advantages, are they sustainable? And are they growing or are they stable? Those are the strategic judgments you'd like to make that you would like to use in your valuation. So rather than a DCF approach, what you would like is an approach to valuation that organized the information about the value of the company from most to least reliable. So you could say, I know this value at a minimum is there. This second piece of value may or may not be there, and this last piece of value is where the hope and the dream is. It's hard to do with a DCF approach. You'd also like to be able to organize it by strategic assumption. This is what this company is going to be worth if the industry is not viable, and this is what it's going to be worth if it's viable and there are no barriers to entry, so it's a competitive market, and this is what it's going to be worth if its existing competitive advantages turn out to be sustainable. You would like to be able to relate your valuations and valuation approach directly to those strategic judgments that you can make. And I think it's fair to say it wasn't easy to do when you guys had finished your valuations in 6301. The good news is that there is, in fact, an alternative approach to valuation that achieves all of that. And it is, in fact, the approach pioneered by Benjamin Graham and David Dodd at this school, basically in the 1930s and 1940s. Are there any questions about your miseducation in 6301? All right, so let me start with what we probably should have taught you to do. So what is the most reliable information that's out there? Let's just start with that. It is the balance sheet information. Why? Because it is tangible. In principle, you could go out and check every item on that balance sheet. You could look at the cash, and it's there at a given moment in time. You can look at accounts receivable, which are the debts that are owed to you by your customers. You could see the level of those at any given moment in time. Inventory you could go out and check. Property, plant, and equipment you could go out and check. Even intangibles you can generally look at. If the intangible is a product portfolio, you can look and see if it's there and what the quality of it looks like. If the intangible is store traffic, you can look at store traffic and actually ask questions about how expensive was it to build. If the intangible is a trained labor force, you can look today at the quality of that labor force. So you can actually look at those things today and you can begin to say what they are worth without making any other assumptions. And that's where you always want to start your valuation. Then you're going to overlay strategic assumptions on the asset value. So if this is a non-viable industry, how are we going to value that balance sheet? Liquidation value. Now, we can do an unsophisticated liquidation value, which is just go down it and see what we can recover, or we could do a sophisticated liquidation value where we drive it into the ground over, say, the next 3 to 5 years and look at what the cash outflow is. They're not going to be hugely different numbers, but we know what to do in that case, and we don't have a problem with this terminal value if, in fact, this is a non-viable industry. Newspapers are not hard to do. If it's a viable industry, how are you going to value those assets? Reproduction value, because for the industry to be viable, earnings have to be sufficient to justify continued reinvestment at the most efficient way, in the most efficient way possible, in capacity in that industry. That means that the value of the assets you've got there is what it would cost somebody who is entering the industry to recreate in the most efficient way possible that asset base. And the earnings ought to be driven in a competitive industry by that required level of asset investment. So the balance sheet is really where you're going to start. And you're going to start for a non-viable business with a liquidation value, and for a viable business, you're going to start with the value of reproducing the assets. How many of you did that in 6301? Oops. Then, of course, earnings matter. But what were your most reliable earnings estimates? They were, in a sense, as the company sits there today, over an average cycle with an average management or an anticipated average management, what would its earnings be? Where the earnings are the earnings we could distribute to investors after tax and still leave the company in the same position at the end of the year as it was in at the beginning of the year. It's basically the after-tax profit when you take out depreciation, when you don't subtract depreciation, minus the required maintenance capital expenditures. Why don't we just look at that next? No speculation about growth, no speculation about future profitability, and ask ourselves at a reasonable required return, which is what a weighted average cost of capital is, what is that earnings power worth? And that gives you the second most reliable piece of information you have. It is the value of the current earnings power of the company. Now, it's less reliable than the asset value because you have to project. You have to say, well, this is the value if these earnings are sustainable over time, whereas the assets are just there. But it's a hell of a lot more reliable than the value of growth. Those two things will, in fact, tell a story. And it'll tell a story that is, in some sense, consistent because those two estimates are not independent. Suppose that read earnings power value instead of market value. Suppose I was in the chemical, just a commodity chemical business, and the value of the earnings in this year was $2 billion, And the value, the cost of reproducing the assets is $1 billion. What's that company going to be worth? And remember, the strategic assumption is there are obviously no barriers to entry here. This is a commodity business. Is the $2 billion value of earnings going to be sustainable? No. Chemical companies are going to look at that and say, I can create $2 billion worth of earnings for $1 billion investment. And what are they going to do all day long? They're going to invest. What's that going to do to prices of this chemical? It's going to drive it down. What's that going to do to the value of the earnings? It's going to drive it down. To drive the value of the earnings down. Suppose it drives it down from $2 billion to $1.5 billion. Does the entry stop there? No, they can still create value. Where is that process of entry going to stop? When the earnings power value has been driven down to the asset value. If it were below the asset value, what would start to happen in that industry? People wouldn't be investing, capacity would come offline, prices would ultimately go up, and they'd have to keep going up until they attracted the new investment. So in a business without a commodity business, what should be true of that earnings power value if you've calculated it properly and the asset value? They should be the same. Now, for the moment, I've ignored growth, but I'm going to tell you how to deal with that in these businesses too. What about a product that's differentiated like luxury cars? Is that a different business altogether? Does this principle only apply to commodity businesses? And the answer is no. When they told you, and we're going to talk about this, Tano's going to talk about this at great length next week. When they told you the way to get yourself out of a commodity business was to differentiate your product, they lied. It is not. In brand terms, what are the, that is, in the terms of what constitutes brands, which is a luxury, high-quality image that you'll overpay for, what are the most powerful brands in the world? Anybody says Coca-Cola, I dare them to show up to meet their new in-laws and expect to impress them with a six-pack of Coke. It is the big luxury car companies. They have differentiated products. It's the Mercedes-Benz Star, the Cadillac Shield. They've even entered the language. Suppose that in luxury cars you had a situation where the asset reproduction value, including the engineering, the design, the dealer network, and the advertising image was $25 billion, and the earnings value was $40 billion. And that was basically the situation in the United States. In the 1960s, General Motors' return on capital was 48%. What happens then? First, the Europeans look at that market, BMW and Jaguar and Daimler, which is Mercedes, and they say, we can get into that market. And they enter. Now, prices don't go down, but what happens to Cadillac sales at the old price? They fall. You're not going to sell as much at the old price. If your sales fall, what happens to your unit fixed cost of product development and advertising for sustaining the brand? It goes up because you're selling fewer units, and if anything, you've probably got to spend a little more on that. If your unit fixed cost goes up, your variable cost isn't going down, and your prices certainly aren't going up in the face of competition. What happens to profits? When those Europeans enter, they go down, and the earnings power value goes down. Suppose it goes down from 25, from 40, to 30. Well, the Japanese are going to look at that and say, I can still create a lot of value for my $25 billion investment. And now Lexus and Infiniti and Acura enter. It is not enough to differentiate your product. There have to be barriers to that process of entry. And that's what, by the way, competitive advantages are. Incumbent competitive advantages, which are things you can do as the incumbent that potential entrants can't, are exactly the same as barriers to entry. But in the absence of barriers to entry, whether it is a commodity product or a differentiated product, ultimately, what is competition going to drive the value of those earnings to? The cost of reproducing the assets. In fact, it's generally worse. I tell one terrible joke, but it's one I'm fond of because I lived through this. And if I could kill our dog, I would, but I can't. How many of you are married? How many of you have kids? How many of the kids have pets? Good. Oh, well, you're too late for you. The thing you have to understand about pets is it's a hell of a lot more fun to buy a puppy than drown it later. Which means that once you've bought that puppy, you are stuck with it. Now, the same thing applies to entry. It's a hell of a lot more fun to enter and build the capacity than to get rid of it later. So you spend a lot of time at excess capacity in these industries because people overbuild. So if anything, the returns are slightly worse than this. But the basic dynamic is that if there are no barriers to entry, that earnings power value and the asset value ought ultimately to be driven to the same level. So they ought to be approximately the same. And that is good for you. Because what it means is that the strategic judgment that there are no barriers to entry enables you to triangulate your valuation so that you can compare your earnings power value to that asset reproduction value, and you get two observations which are going to be a lot better than one. But what about growth? I haven't talked at all here about the value of growth, which matters in principle for a lot of companies. How many of you think growth is unambiguously good? How many people think it's not unambiguously good? Most of you have no opinion. There is one good thing about growth. A growing income stream is much more valuable than a flat income stream of the same initial level. The bad thing about growth is that you have to invest to support the growth. It's very, very rare, almost non-existent, that the growth comes without any investment at all. And what that means is that the average level of the stream at every point in time will have the subtraction of the growth investment. So the initial distributable profit stream for the growing company will be lower than the distributable profit stream for the non-growing company. The question is, at what point do those two forces exactly balance? And there is a very simple answer to that. And what I want you to think about is not the rate of growth itself. And this is an advantage of thinking in Graham and Dodd terms. But think of the asset investment that you have to make to sustain the growth. So let's imagine I'm investing $100 million in growth. First thing is I have to pay the investors who supplied that money, whether it's from retained earnings or not. I have to justify the use of that money. And suppose they could earn 10% on it elsewhere. So the cost of that money is 10% of $100 million is $10 million a year. When does the growth generate returns that outweigh that cost of investment? Think first about a crappy management investing that $100 million in an industry where it's operating at a competitive disadvantage, where other people have scale, other people have captive customers. They're not going to make 10% on that money. They'll be lucky to make 5% of that money. So if they invest under those circumstances over here, they make 5%, which is $5 million. They pay $10 million to the people who provided the money. The net income created is minus $5 million, and they've destroyed $50 million in value. So growth at a competitive disadvantage destroys value in almost every instance. What about if they're investing in a competitive market, like the market for luxury cars? Ultimately, what's that return on the $100 million going to be driven to? Well, if it was 20%, what would happen? You get entry. An entry would drive down the profitability. So ultimately, I don't care how many real options are there. Ultimately, competition is going to drive the return down to that 10%. So now, if there are no barriers to entry, it's a level playing field. You make 10% on the $100 million, which is $10 million. You pay $10 million to the people who provided it. The net value is zero. Growth in a competitive market generates zero value for the existing shareholders. The cost of the capital investment exactly is offset by the increase in income and vice versa. So without barriers to entry and a reasonable quality management, what is the value of growth? It is zero. So we don't have to worry about growth at all. All we have to worry about is the current earnings power and that asset value. Yes?
Even if you're earning above the cost of capital right now, but there are no barriers to entry, you're going to get, over time, that's going to get wiped out. You see the normal returns get wiped out. There is value to the growth in
It is tiny. It is tiny. Some people are going to show you how fast the reversion to the mean is. And it's very fast. Plus, remember that for every period where you have that short-term competitive advantage and the people rush in, after they've rushed in, what is that industry like? It really sucks for a long time. You'll find that out when you have the equivalent of a 95-year-old human-age dog who has to have every door in the house open and craps all over everything at his leisure, which is what I live with. Remember that. And if I shot it, my daughter would be upset. As with my wife. I'm sorry, go ahead.
Even if there is a competitive advantage, you're going to get that, depending how soon your returns
Okay.
require you to make an estimate of how long that lasts.
No. What we're going to do, okay, this is the trick. When does growth matter? It matters when, for example, it's the internet, and that 100 million generates 10 billion in sales and $1 billion in profits. Now, if there were no barriers to entry, what would that extra $1 billion in profits do? It would attract an enormous amount of competition very quickly on that. But if it's not there, and it's sustainable, there are barriers to entry which prevents the competition, then we have the old problem of how do we value growth. And what we're going to learn is that the way, even in the difficult circumstance where you have to worry about valuing the growth, they taught you to do it in 6301 was completely wrong. In fact, I'll give you a sort of preview of what you're going to learn here. You were taught that there were two ways to evaluate projects, right? An NPV and an IRR. Which were you taught was the most reliable thing to use? NPV. That is right for the projects where the growth doesn't matter. When the growth matters, when you try and do NPVs, you have this extraordinary sensitivity to the assumption about the rate of growth. It has huge effects on your valuation and means that your NPV valuation is very inaccurate and very hard to pin down. What do you think happens? What is the effect of growth on the IRR? Well, if it grows at 6%, it just adds 6% to the IRR return because you get a 6% capital gain, all else being equal. So there, the connection between the growth rate and the cost of capital And the return that you get is much more transparent. So it turns out when you look at great investors like Warren Buffett or like a guy called Glenn Greenberg, who have extraordinary records over long periods of time, when they evaluate growth stocks, they don't look for a dollar value or an NPV. The question they ask is, at this current valuation, with reasonable assumptions about growth and the stability of profitability, which comes back to how long is this competitive advantage going to last, what is my return? Buffett's target return is 13%. Glenn Greenberg's is 15%. And actually, since Glenn Greenberg started in 1983, he's done slightly better than Buffett on his investments. But when we come to evaluate growth stocks, it turns out we're going to have to do it entirely differently. Precisely because of this problem of the extreme sensitivity of the NPV value to those terminal assumptions about the growth rate and cost of capital. And remember, what a valuation machine does is it makes as transparent as possible the relationship between the critical assumptions and the valuation measure that you're talking about. So when we come back to valuation, as long as we're not operating at a competitive advantage and growing at a competitive advantage, we can ignore this very uncertain element of value, which is the value attributable to growth, because in the long run, it's going to be reasonably small. Yes? Sorry? No. Hold that question. Scale is a competitive advantage, provided you can defend that scale. And Tano is going to talk about that next week. Trust me, we'll teach you what a competitive advantage is. And it's not growth. So in terms of growth, we're basically going to defer looking at growth, knowing that growth at a competitive disadvantage or with a bad management destroys value. Growth on a level playing field neither creates nor destroys value, so we can ignore it. And it's only in these franchise businesses, the so-called Buffett businesses, that we have to worry about growth, and we're going to value those in an entirely different way. So what we're going to do is an asset value and an earnings power value, and I'm just going to talk for the last half hour about the mechanics of calculating those two things. Well, the way you do an asset value is you just work down that balance sheet. And remember, if we think this is a non-viable industry, how are we going to work down that balance sheet? We're going to do a liquidation value. If it's a viable business, what we're going to try and calculate is the cost of reproducing those assets that are necessary to the business. If I start with cash and I've got $100 million in cash, what's the cost of reproducing $100 million in cash? It's about $100 million. So cash is easy. What about accounts receivable? Remember, how do you produce accounts receivable in practice? If I have $200 million in accounts receivable, what would it take an entrant who wanted my same scale of business to have $200 million in accounts receivable? He'd have to sell about $210 million to people. Why? Because some of those people aren't going to pay him back. So the cost of reproducing that $200 million in accounts receivable is actually higher, not lower. It's not very much higher. It's going to be pretty close, but it's not going to be lower. You're not going to take a haircut on that. That's in the event of a liquidation value. If this is an economically viable business, you have to get repaid for what you invested in those accounts receivable, just like any entrant would have to. So at a minimum, you want to add back the allowance for bad debt. It's not going to be a big adjustment, but at least it will get you to think in the right way about how you're calculating this reproduction value. Inventory, again, sometimes you do have to take a haircut. If it's useless inventory, obsolete products, input materials that you bought at too high prices, you're going to have to mark it down. And the accountants usually force them to do that because an entrant would not make those stupid products. You would have done their market research for them, and they would not have bought the commodities at high historical prices. In general, though, as I say, the accountants, if they're doing an honest job, should do the write-down for that. The adjustment, presumably, you have to do to inventory is that when you enter a business, you enter a business on the basis of first in, first out. You can't sell the stuff that you're going to produce 3 months from now. That means that if you're doing LIFO accounting and you have a LIFO reserve, you have to add back the LIFO reserve. If you're doing FIFO accounting, go ahead and just use the accounting inventory number. Now, these are not going to be big adjustments, and when you do a quick and dirty, you're just going to work down the balance sheet. The harder things to get at and where you want to concentrate your time are property, plant, and equipment, tangible, long-lived assets, but increasingly importantly nowadays, intangible assets. And what I want to do is talk to you through about how a calculation of intangible assets might be arrived at. But also, we're then going to talk about getting reproduction values for tangible assets. First, you need a listing of what the intangible assets are. They will consist very often of a product portfolio. An entrant will have as a rule to develop that product portfolio. Now, you have to be a little bit careful here, because if the entrant is going to be a foreign firm that's already developed that product portfolio, that part of the reproduction cost by the entrant is going to be zero. Remember, you're looking at the required investment here that is going to protect your earnings power. If they've got to develop the product portfolio, when you read the descriptions in a company, they'll usually tell you how long ago their products were developed. Typically, most of them in cases where R&D matters at all, where the product portfolio matters at all, it's in the last 5 years. Well, you know what the R&D budget is because that's reported. So if it's 5 years, it's 5 years worth of R&D. If it's 3 years, it's 3 years worth of R&D. Now, sometimes you can't do it that simply. If you look at drug companies, they spend enormous amounts of money on developing products. On the other hand, what you see today is that more than 50% of the new chemical entities are actually purchased when they buy small startup biotech firms. Look at the prices that they're paying divided by the potential revenue. And that'll give you an idea per dollar of revenue what the product portfolio is worth. So sometimes you can compare this 5 years of R&D or 3 years of R&D to what people are paying for comparable product portfolios out there. And again, the more information you can get, and this is all information that never occurred to any of you to look at when you did your 6301 projects, is it clear the better off you're going to be, because the more likely you're going to be on the right side of the trade. In terms of customers, customers actually don't come cheaply. Your sales usually represent an asset. And you ought to think about what might be a cost to an entrant of acquiring those sales. One measure is you can just look at the sales commissions that are paid. If people are paying industrial sales groups commission for sales generated, what's the value of that sales base you've got? It's about 7.5% times the value of the sales. Sometimes there's an industry number. I mean, there's a huge amount of information in credit cards as to how much it costs you to get a new active credit card account. Used to be about $80. It's now about $400. And you can multiply that by the number of credit card accounts that you have, which is, again, the cost that an entrant would take to build up. In some cases, what you can do is just look at the history. So if you look at a Home Depot store, in the first year its sales are 60% of average sustainable sales. The next year it's about 78%. Then it's 84%. Then it's 93%. Then it's 100%. You know, usually, because the retailers will report this, what the four-wall economics looks like. So you know how much profit they sacrifice when they start a new store. And that turns out to be about 20% of the ultimate value of the sales of the store. That means the value of the sales at Home Depot's is 20% of sales. On the other hand, if the store is a fashion store in a mall, how fast do you think the traffic build is? Almost instantaneous. They're almost at full build within 3 months. What's the value of the traffic in that case? 0, because it's all in the range. So you have to have a sense of what the cost of generating the sales are. And again, if people are buying store chains, you can see what they're paying implicitly for mature stores with mature traffic. You've got trained workers. Companies will report their labor force, and in some cases, you can get how many of them are professional engineers and so on. Well, we know what headhunters charge as a percentage of a year's salary for producing the product of a successful search. It runs from as low as 15% for secretarial workers to as high as 3 years' salary for CEOs. I'm sorry, half a year's salary for CEOs. Normally, it's in the range of 25 to 35%. Add up their wage bill and multiply it by that factor. That's what it would cost somebody if the entrant is going to have to develop that labor force, and that's going to be true of a foreign firm entering. In the case of brands, you have a lot of brands that are bought. Liz Claiborne used to buy a lot of brands. Jones New York used to buy a lot of brands. You sort of can get a feel for what they're paying for potential sales. At the same time, there are a lot of business plans out there that experienced people in the field have developed. And business plans for new brand development typically consist of a cost part of it. When you're doing the design, you're lining up the suppliers, you're doing the advertising and doing the selling into the store, which is more or less what people pay attention to because it drives budgets. And then there's the fantasy of what the revenues are going to be. Well, the cost of developing that brand you can get from the business plan. Brands are typically successful, and the bigger the brand, the greater its reach, the more expensive that is. The cost, by the way, runs about 20 to 40 cents of mature sales. Brands are successful, brand introductions are successful between a half and a third of the time. So you have to blow that up by 2 or 3. But you have an average cost of developing those brands, assuming everybody has equal potential access to those markets. And a lot of it comes from these private market values, which what people are willing to spend for this. So what are you going to do for intangibles? You're going to list them, and you're going to look item by item at a good estimate of reproducing them. And if you can triangulate, you have a private market value that people have paid in transactions to buy the brands, and you have these direct measures of cost of development. You want to do both. The more information you have, the better. In terms of tangible assets, a lot of commodities like oil reserves trade, and you have a lot of information on lifting costs. So you can look at reserves of different quality and what they trade for. All these big oil companies have exploration and development budgets. You can see how much they produce in terms of proved reserves ultimately as a fraction of what they spend. It runs from about 20 cents on the dollar for ConocoPhillips to as high as 80 cents on the dollar historically for Apache oil. That you can look at too. In terms of plants themselves, what you also have, by the way, in a footnote is the original cost of what was in place. Typically, on average, how far through its useful life is the current plant of a company going to be that's not growing? It's going to be halfway through its useful life. The faster the company is growing, it's not going to be much below 40%. The younger the capital is going to be. So say it's halfway through its useful life. The value of that property in place is half its original cost. And the only next adjustment you have to make is, are the costs of new capital equipment going up or down? There, the trend typically has been downwards. Capital equipment costs have been going down because of the improvements in data processing speed at 4 to 6% a year. So if this equipment is on average 5 years old, then you've got to write it down by about another 30 to 35%. I'm sorry, 20 to 25% for the decline in value at roughly 5% a year. But that's a calculation you can do, and you'll get an idea of the reproduction value of the capital. For buildings, you're not going to take any write-down. For construction in progress, you're not going to take any write-down. Sometimes the plant in place will be characterized by a capacity. So you will say, okay, this is a refinery with 600,000 barrels a day. That's a big refinery. Say 60,000 barrels per day capacity. Refineries get bought and sold, and they'll tell you refinery capacity gets bought and sold at X. New refineries cost typically per barrel of capacity about $2,000 per barrel per year. You can just multiply that rated capacity by that cost. But here you have to be extremely careful. There is a big difference in how the capacity is going to come online as that industry remains viable in the future. You want the lowest cost way of producing that capacity. Typically, you can either build a whole new refinery, which is greenfield capacity, which costs $2,000 per barrel per day, up to $5,000 per barrel per day. How many new refineries do you think have been built in the United States in the last 30 years? Zero. What do you think has happened to refining capacity in the United States? It's gone up by 25 to 30%. Where has it all come from? Brownfield capacity. It's investments that extend the capacity of what's in place, and the estimates there are is that brownfield capacity costs about not $2,000 to $5,000 per barrel, but somewhere between $600 and $1,000 per barrel. Which number are you going to use for the reproduction cost of your refinery? It's going to be the brownfield capacity, because that's the most efficient way to bring it online. So you're going to work down that balance sheet. You're going to look at all the various categories of assets. You're going to do the necessary research to get a reproduction value for those assets. And then probably you're just going to subtract, without much adjustment, the value of the liabilities, although you could write those down to market too. And that'll give you a reproduction value of the assets of a viable business. Are there any questions about that? Yes?
I can figure out the market value of the debt.
All right. In the debt footnote, they will tell you the interest rate that they're paying on all that debt. You will know what comparably rated debt is trading for today. You can just do a yield calculation on the value of the stream of payments for the contractual debt at the new cost of capital. Now, you should program it. Don't do it for every single debt issue. But it's quick to do if you've got it programmed. Okay? Now, there are several things you probably want to keep in mind. Management adds value. Good management always adds value to the asset value. And bad management always destroys value from the asset value. When you use these transaction values, be really careful. A lot of people got screwed because, for example, in cable, AT&T was paying much too much for cable points of presence. And then AT&T gave it up. They thought they were going to get into the local telephone business ahead of their time through the cable pipe. They bought a lot of cable systems at hugely inflated values. When they decided to get out of the business, the transaction values for cable customers fell by half. Be really careful in using those transaction values. And don't have them driven by earnings. Sometimes book value does almost as well. That you'll notice that in Kano's regressions, market to book or book to market identifies good opportunities. But presumably, you ought to be able to do better with systematic studies of industries. And remember, in non-viable industries, it's the liquidation value that you want to concentrate on. All right. I need a volunteer. Can somebody pick up my slide that just fell off the table? Kevin, sorry. So you've done an asset value, and now you want to triangulate that with a value of the current earnings, which is the value of the earnings of the company as it stands there today. How are you going to measure it? It's going to be just the sustainable earnings or earnings power, the average earnings that that enterprise should be able to produce over the cycle times 1 over cost of capital. It's the second most reliable information. How are you going to calculate earnings? You're going to do the accounting income plus adjustments. The cost of capital is going to be a WACC. What you typically want to do, for reasons I'm going to describe in a second, is get the value of the whole enterprise. Don't just look at the value of the equity. Because if you've got an enterprise that's worth $1 billion and it's got $900 million in debt on it, the equity could be a real bargain, but it's just because it's so risky. You could be off by 10% in your estimate of the value of the enterprise, and the equity would be worthless if it's that small stuff. So look at these as an enterprise as a whole, which is why you want to do it. If you then want to get the earnings power value of the equity, take the earnings power value minus the value of the debt. The assumption here is clearly that that current profitability is sustainable. All right, so the first thing you have to do are the accounting adjustments. Now, start with earnings without the one-time charges. If they then have recurring, non-recurring losses, take the average value of those and just subtract it, because they clearly don't occur in the year where they're recognized. So first you want to clean up any accounting adjustments that they've done. Once you've done that and you've got a fairly clean accounting operating earnings, then go ahead and look at average margins over a cycle. Now, why margins? Because margins vary a lot more than sales. Current sales are probably going to be reasonably close to sustainable sales. Sometimes they're inflated by 10 or 15%. Margins can vary by a factor of 2 to 1. So start with a sustainable margin level. Start with the average level of those margins over one cycle, which say you've got good times and bad times. And usually that's going to be at least 5 years. More often it's going to be 10. If you looked at margins from 2002 through 2007 on industrial companies, you got a hugely inflated idea of what sustainable margins were, because Chinese and other growth, steel and all sorts of other commodities were historically high margins for the whole 5-year period. So go back and look over a cycle if you can, multiply it by sustainable revenues again. If oil prices are up at $180 or $150 a barrel, that's obviously not sustainable in some sense. So in extreme cases like that, you're going to take a write-down on revenues, but in general, current revenues should be pretty close to what you're going to see. As you do this, you will get a sense of how stable these numbers are. If margins have no clear trend to them, that's a good sign. If margins are deteriorating steadily, you've got a tough decision to make. Probably you're going to use the most recent margins. If they're increasing steadily, again, you're going to have to make a judgment about how that compares to over the cycle. So you've got an average margin, you've got an average level of sales. That'll give you an average level of earnings before interest and taxes. Now, sometimes the big adjustment you're going to make actually has to do with investments that get expensed, and we'll talk about those. But the simplest and first adjustment you're going to make is, after you've done 1 minus the average tax rate to get a net operating profit after tax, is to add back excessive depreciation. How are you going to get excessive depreciation? What you've got to do is subtract average depreciation from an estimate, or you've got to subtract an estimate of maintenance capital expense from average depreciation. Maintenance capital expense is what depreciation should be. It's what you have to pay to restore the company at the end of the year, its capital stock at the end of the year, to what it was at the beginning of the year. And again, since depreciation estimates are a big source of error, you want to triangulate as far as you can. Sometimes you can just do an estimate of how much of the capital expense is growth, subtract that from the overall capital expense, and you'll be left with the maintenance capex. For example, growth for stores like Tiffany, or a big company like Tiffany, consists of what? New store openings. They will tell you, or you can find out, what the investment per new store opening is. They typically don't own their stores. It's about $3.5 million. They open 15 stores that year. You know what the growth capex is. The remaining capex is presumably maintenance capital expense. Sometimes you can look at the replacement directly. If you look at cable companies, how much do they have to pay to replace the cable in the ground? Nothing. It lasts forever. When the rats eat it, they actually have to send the repair crews out, and they expense that part of it. On the other hand, what happens to the set-top boxes? They have to be replaced. They typically don't get much from reconditioning. So set-top boxes, except for the new households coming on, are almost all maintenance capital expense. So look at the number of customers they have, what the churn is, how many of them turn over every year. Say it's 12%. If they've got 10 million customers and the churn is 12%, they got to replace 1.2 million set-top boxes a year. You know what set-top boxes cost. You can just call Scientific Atlanta. You can get what that maintenance capex is. Actually, the cable companies and a lot of companies will break out their capital budget for you, and you can see what the maintenance capital expense is. Sometimes the company will actually tell you. So Burlington Northern, which Buffett just bought, reports every year maintenance capex. And we don't think they're lying about it because the number of miles of track in the system have been shrinking steadily. And it's typically almost all of capital expense. And it's much bigger, by the way, than depreciation. But you're going to get an estimate of the maintenance capital expense. You're going to subtract it from depreciation, and you're going to add that back to your profit number. Second thing you're going to do is the top line here. When Home Depot opens a new store, it actually sacrifices profit because its sales of that new store are 60 to 65% of total sales in the first year, and they lose money. But you know what that number is, and that's really a form of investment. And you can calculate that loss and just look at the number of new stores that got opened. And you can calculate sort of directly expensed investment that way and add it back. For Intel, obviously, as their revenue increases over time, although it's stopped doing that, some fraction of the R&D budget is going to new products. In the old days, it was probably half. These days, it's probably almost nothing, because revenue, as I say, hasn't been going up. So what you want to do is add back expensed investment, because if the company doesn't grow, you could distribute that, and you want to add back excess depreciation. And that ought to be distributable after-tax earnings. Once you've got that, and also, by the way, you also do adjustments for non-consolidated subsidiaries where you may have to, if they're big, you're going to report them separately. Then you've got an earnings power. You multiply that by 1 over a weighted average cost of capital, and that will give you an earnings power value. How do you get the weighted average cost of capital? Well, the cost of debt is easy. You all did this in 6301. It's the contractual cost more or less times 1 minus the tax rate. It's usually a little more because there's some probability of, a little less because there's some probability of default, and the expected payment is slightly less than the contractual debt. Multiply that by the fraction of the company that's financed by debt. How do you get the cost of equity? You were taught to do the capital asset pricing model, right? It's a complete waste of time. And I'll show you why. If you look at the cost of equity from the capital asset pricing model, it's a risk-free rate, which we think today we can measure pretty accurately. It's about 1%. It's a little more than the average short rate because, of course, it's the average short rate over the future for which you're evaluating the project, plus the beta times the risk premium. What do estimates of the risk premium are? Well, some people think it's 4, some people think it's as high as 10. And it's varied over time in that range. What's an average estimate for beta 1? What's the range of error in beta estimates? It's actually plus or minus a half. So you could get an estimate here from 1% plus 1.5 times 10, which is 16%. This is 15. To 1% plus a half times 4, which is 3%. How useful is an approach that ties the cost of capital down between 3 and 16%? It's a waste of time. What you want to do is recognize, start with what they're paying on the debt, which is, say, 6. That's a lower bound on what the cost of equity is. what's an upper bound on the cost of equity? Well, the most expensive equity, and it's bizarre that this is the case because it's probably not high beta, but beta, again, as Tano showed you, doesn't correlate with returns. The highest cost equity seems to be venture capital. And venture capitalists will tell you what they had to earn on their last fund in order to sell their next fund. That's presumably the expected return that investors require, and that number today is about 15. So this is the realistic range that you have. The risk premium has got to be at least a couple of % for equity. So realistically, you're going for a cost of equity between 8 and 15. If it's low risk, the cost of equity is 8 to 9. That's a very stable business with low leverage. If it's intermediate risk, it's going to be 10 to 11. If it's high risk, it's going to be 12 to 15. You do better picking in those ranges and qualitatively judging things than anything you're going to do with a capital asset pricing model. In fact, when we used to do the examples for the capital asset pricing model calculations, we picked companies where the number produced by this actually made sense. And it wasn't so easy to find those companies. So just make a judgment about the cost of equity and put it into that weighted average cost of capital. So you adjust it for depreciation. You've got the weighted average cost of capital. You've got an earnings power. You take 1 over the weighted average cost of capital. That gives you, remember we started with operating earnings after tax. That gives you the value of the earnings of the operating business. That is just the starting point here for the earnings power. Because in addition to the operating business, businesses have non-operating assets. They have cash that's in excess of what they need. They often have real estate that's in excess of what they need. You want to add back the non-operating assets. And that's the total earnings power value. Now, those non-operating assets are automatically included in the asset value. So the asset value is actually simpler to calculate. For the earnings power value, it's the value of the operating earnings of the business after tax, obviously, plus the value of the excess assets. Again, that's an enterprise value. To get the value of the equity, you have to subtract the value of the debt from that. The EPV of the equity is comparable to the asset value of the equity. The earnings power value of the company is comparable to the asset value of the company. When you've done all that, this approach will tell a story. The story is one of these 3 things. The first case, you've got huge asset value and relatively small earnings power value. What's going on there if you calculated these things properly? Well, you could have made a mistake. It could be a dying industry, and you've done a reproduction value of the assets when you should have done a liquidation value. More often than not, the first case means that management was not making the best of those assets. They're not producing earnings commensurate with the value of the assets that they have. If that's the case, what is going to be the critical focus of your research? So when you did your projects in 6301 and you saw that this was the case, what was the critical determinant of the ultimate value of that company? Whether you could get rid of the management or not. Whether there were activists who had significant shares in it and was under threat. Whether the guy who ran it was 101 years old and his favorite daughter had breast cancer, so the family was going to die out, and you were going to get a decent man and professional management in place. But in that case, what's That's the crucial document that you have to read. It's the proxy statement. It's who are the management, what's their power, who are the big shareholders, what are they doing? What's the second story is one where the earnings power value and the asset value are about the same. When and where should that be the case? That should be the case when there are no barriers to entry. If there are no barriers to entry, you would expect the properly calculated earnings power value to be equal to the reproduction value of the asset. Because that's what competition should do. And it means you have two separate observations on the value of that company. The last case is the one where the earnings, it's the Coca-Cola case, where the earnings power value is hugely in excess of the cost of reproducing the assets. There, if you're going to buy the earnings power, which you're almost certainly going to have to do, the crucial issue is what Tano is going to talk about next week, which is, are those earnings sustainable? Are there competitive advantages here, not just growth? And there, too, the process of valuation is very different. So in this case, if you also make the supporting judgment that there are competitive advantages here, you have to approach valuation from a slightly different perspective. Sometimes you will decide that there are no barriers to entry and the earnings power value and the asset value are not that close together. You have to ask yourself, which are you going to trust? If the earnings, this is a commodity business and the earnings are very unstable, but the asset base is stable, companies like natural resources or industrial commodities like steel, which is going to be the better estimate of the long-term value of that company? It's going to be the asset value. So you don't have to try and forecast what the price of oil is going to be or what the price of copper is going to be. You just have to value their reserves at the currently available prices, value the cost of reproducing the plant in the most efficient way possible. If the earnings power value is reasonably stable in clothing, tools, food products, things like restaurants, but most of the assets are intangible, so it's hard to get your arms around, then you're going to put a bigger weight on the earnings power value rather than the asset value. But having two separate estimates is going to enable you to do a lot better in the valuation of these companies than one smushed together stupid estimate that you got from your net present value. Now, actually, next time we're going to do the very first valuation, which is Hudson General. It's in the book, but let me just say something about it. The way you want to start valuing all these companies is to break them up into their piece parts. If it's a single line of business, go ahead and just do the consolidated balance sheet. But if it's not, you want to try and get your arms around the individual businesses and the individual assets. So if you're actually doing drug companies, you break it up into the existing portfolio. What are the drugs they have worth? And that's a liquidation value, because as they go off patent, they liquidate. You want to value the pipeline, the expenditures plus the adjustment factor for how well they seem to have done, and then they may have local economies of scale and distribution. And you want to value that infrastructure. And we'll talk about how to do that later. American Express, you've got credit cards, loans, and a network services business. Nestle, you've got a whole bunch of different product lines. And then you've got lots of securities that they own and things like that, which is a drug company. You've got to do it something. So when you go out and value these non-franchise businesses like we're going to talk about, you want to look at asset values and earnings power values and the strategic assumption that there are no barriers to entry here, and you should do a lot better than the idiots who just do 6301. Sorry I ran over. We'll try and give you the time back on Thursday. When you want to get out, get something.
Yeah, he's like summarizing his book.
Are you serious? Where? Oh, like in
There was somebody right in front of me who was like taking pictures. I'm sorry. Tons of deliverables that are going to be really, really rough.
Calculations and stuff that I'm not very familiar with. And other people are. That's what I mean.
I go to the bathroom. You want to talk? You want to talk to Greenwald? Oh, yeah. How you doing? What's going on? You doing things tonight?
I'm going down. It's Australia Day today.
You were in Australia today?
No,
Oh, was it?
no, it's Australia Day today.
Oh, it's Australia Day today.
It's Australia.
That's
It's
a
like
great day. So what are you gonna
Be
do?
happy?
Yeah, I'm extremely happy.
And what you do is go to somebody that's retired and see hundreds of clients, and he'll tell you what these costs look like and what the calculators is. Well, then you go to somebody who works with a different company, and you get a very small. No, when you're trying to do it up, no, that's right. What you're doing is trying to do this. If you rely on the calculators, what are we talking about? Looking at the cost of the It's not the competition. It's that the investment just so that $100 million what was the net value? The growth requires investment. It's not that there's no growth. Trust me, that is
You have to change it about it.
probably
Oh, that's right. So we're like, we did lots.
all of that. All of a sudden it shows a huge increase in value, and this is a competitive business. What do you think is the value?
Comes back to the competition,
Right.
not just
So you
price
better
per
understand the difference between a competitive industry with no barriers
growth. Okay.
and an industry with barriers to entry. We're going to talk about that next week. Okay? And there's a chapter in there.
Yeah.
But it's not that there's zero growth. It's that the growth creates
Growth leads no value,
because
but
the cost of the investment
it's
offsets the
competition.
value. No, the competition means the value of the investment is smaller. That's the creation. So the value created above what you have to invest
It just seems
counterintuitive.
it does, especially
You
when
learn
you think,
something.
yeah,
So who is
especially
your financing stock? So back to the next one.
yeah. No, but when I think about investing, it's the fact that
I'll tell you what.
yeah.
Why they don't teach it jurisdiction for the one.
I was going to ask, you're talking about new build new stores and having a ramp up, and you want to add back that investment cost. I didn't quite follow. So I have questions.
Suppose Home Depot, remember, when you do an earnings power, and it turns out, I'll tell you what's really great, when you do an earnings power, you want to so that would mean if it was zero stores, how much profit is and since they're losing in the first year, they'll break even on the second year. But since they're losing in the first year, about 60% of the sales of the different episodes, you want to take the new stores that are multiply the 3 million times the number of stores open and add that back. Because that's what their profits would be if they didn't open those stores. Is that correct?
Yeah, that makes sense. Okay, that's
Now, it turns out Home Depot makes no profit on these stores. We've done the
Period.
calculation. But actually, when you include the traffic building investment, the value of the new store is just equal to the cost of development. Gross at 100%.
We don't have a lot of time to dig into the background of the company and what they're investing in, and you get a growth-oriented type question. Already had it.
These guys expect to be able to be funny and give a good impression.
Happening still alive. It's been happening a lot in my interviews so far. Mostly mutual funds so far that have done this. But I mean, I think they want to hear how I'm thinking, but my question was going to be, how do you differentiate between your growth through acquisitions and growth through CapEx in their terms?
Growth through acquisitions almost never.
Is there a way to discern that from
Yes.
financials?
Yes. If you pay, let's just do what an acquisition strategy is. Okay? Suppose I buy a company through acquisition. Do I buy it or buy it?
No, you buy it.
I buy it at a premium, say 20 to 30 to 50%.
No,
Is that a good investment strategy?
genuinely not. Most of the market will be really provide.
Well, and so you think the guys who are buying these companies are good at investing? Warren Buffett.
More often, yeah, more often not.
No, they're not. So it's a stupid strategy. Only time it makes sense is if you bring something to the table. If you're a strategic buyer. And if you're a strategic buyer,
Cyrus.
Oh, sorry.
How are you? Sure.
No, no.
Need help with anything?
No, let me just get this stuff.
So you can't get rid of the dog, huh? I'll give you 3 cats for a dog.
I like to kill cats too. The fact that, and it's funny that companies that install the pets go this way.
Ended up with, my wife, we got rid of a cat in a shelter. And 7 years later, we're married. Married for a while, we got 3.
You regret it, right?
Yeah, I really do. I used to have nice space when I was living by myself. I had a nice little couch, and
Yeah,
that's all. It's garbage.
but it's also they have to be taken care of when you go on vacation.
Oh, yeah.
Take care of them. The dog has to walk twice a day. It's just,
Yeah, that's hard. That's hard to do for the cat, yeah.
but it's just horrible. So I think that's if you learn one thing, don't buy pets. It's like don't put some tutor to put in access to pets.
How many classes are you teaching?
Just this one.
Just this one?
Yeah, no, I'm down from 7 to 3, which isn't normal. But they're big, so
Yeah. Almost 300.
it's probably, I mean, there are 266 seats. So, and there are 266 students registered, but it's probably, I would say 280. Maybe. Okay, so let's go.
Let me just do this.
Yeah. They don't set it up for me, so why should I clean it up for them?
Hey, Matt, how's it going?
I'm just about to leave. It's certainly, I'm certainly feeling like it is that time. Hey, listen, I'm so sorry to do this again. Can I take a rain check? Yeah, and did you get my email about Thursday? Oh. That'd be cool. That'd be great. I'm sorry. I'm just running a little bit behind. Yeah, I'm a little bit stressful.